I'm Doug McKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome back, everybody.
Welcome back. Beautiful day today.
Oh,
so nice.
Beautiful.
I just gotta walk in between my different activities. Snuck that in.
I just did the exact same thing.
Oh, good.
The birds are out there flipping out.
Nice.
They feel like it's spring. Yeah. So, it's been. I don't know where some of our listeners are, but for us, it feels as though we're emerging out of the winter, which is nice. I'm sure we're going to have some more cold weather, but I think we're mostly past it at this point. So, hallelujah. And we just had the time change, which
helps too. Yeah, which helps with the time change, and the weather's good, right?
Yes.
Yeah. You're willing to get up basically an hour earlier, right? Because you're kind of on the other clock, even though it says 7, it's really 6, right? So you kind of wake up, at 6 o'clock anyways, right? Really earlier than normal, 5 o'clock. I've been waking up at 4 and trying to get myself back to sleep till about 5. Yeah. Well, I don't have little ones anymore that, okay, yeah, I'm knocked out.
Sure.
And, it's just something, I guess, that happens sometimes when you get older. You wake up earlier.
Yeah, I know. 4 is early.
Yeah, it's very, very early. I mean, believe me, I am awake though. I know it's too early to get up, but I'm awake, and then I check a couple things on, email, and I don't know why I do that, but it usually is okay because I rest anyways at the very least, So
Sure.
Enough about me.
Yes.
And all about you listeners.
All of it, yes. So we're going to talk about another quote from the book Becoming Your Own Banker. I think we should maybe just read through the quote and then we'll discuss. Does that sound good?
Well, I just want to preempt it with that I think Nelson was fully aware of where we're going, but he didn't with this conversation, but he didn't spell it out. You kind of read between the lines, and he was a big reader, as people can see in the back of Becoming Your Own Banker. He lists a lot of books.
Yes.
And I'm sure it wasn't the exhaustive list of books he consumed over his 88 years, right? But yeah, we're going to go down a road, but yeah, you got a beautiful voice, so let's hear you read it.
Beautiful voice. Yes, he read, I mean, the amount of books he read on Austrian economics was really something. So this quote is found on page 22 of Becoming Your Own Banker. And again, if you're listening and you've been listening for a while and you haven't gotten the book, we'd really recommend that you get it and read it because it's the source material for everything that we talk about on here. So,
yep.
So it says, but upon reading the contract, in parentheses, the policy, you will find it plainly stated that the owner outranks every potential borrower in access to the money that must be lent. And what he can borrow is 100% of his equity in the contract, in parentheses, the amount that the company can lend at any one time. If that is true, which it is, then what this amounts to is absolute control over the investment function of the company as it relates to the owner's policy. In essence, money can be lent to the other places only if the owner of the policy does not exercise his option to use the money and pay interest instead. So,
Yep.
Lot to unpack there.
Yeah, that's the phrase of the year. A lot of unpacking. Yeah.
But
you're right.
but a very true statement. So I'll let you kick that off there and start
Ah,
talking about what you see in that, because um, I mean
yeah.
it
Okay.
lends
Thank
to
you.
why there's so much power in what we talk about here.
Well, it's a good thing we have two of us, right? Because we might come at it from different angles, right? One of the things I want to state about that statement, that paragraph, is the fact that um, we are making a distinction here. This doesn't stand alone. Obviously, this is about the infinite banking concept and the idea that um, when you put your capital into a place of storage, right? Similar to what we believe is what we're doing with our money when we put it into a commercial bank. It's not quite the same because we don't outrank every other potential borrower, right? Because
Mm,
what we do is we think we're storing our cash, and we store a lot of cash, right? Because all of us at times, leave our money there from days to weeks to months and maybe even years. And
decades.
yep. And what we're doing is we're lending to the bank, and they have offered to give us some rate of return, whether small or bigger. But they're going to give us something for the use of our money. I mean, and there's been a long history of you know court cases. I mean, we're talking going way back in time. I say way back, the early years of our country, and maybe and even before, where there's been the desire to write the rules about banking. And the fact is that they have complete control over what they do with that money, including not lending it to you. So
Hmm.
even though you may have over your lifetime, let's just say you use the same bank, for say 30 years or whatever, right? From the age of 30 to 60. Um, you might have put at different times $1 million in there, right? I mean, it just cash flow going in and out, in and out. And every time it goes in, they can fractionalize it, they can lend it out. And during those 30 years, there could be times where you're not in great shape financially, or as in good a shape as they're willing, or they're not really, the economy is so tough, they don't want to lend to, for various reasons, for various things, um,
So
to
you're saying
various
that if you had
people.
given the bank, let's say, deposited a lot cumulatively over the years, you're basically saying that if you were in a point where you needed a loan, let's say, that they might not give that to you.
Yeah, because when you store your cash with them, you're really lending it. You're not storing your cash there, and they don't have any obligation to say, "Well, you've been such a good depositor
Right.
and
We've made so
lender to."
much money off of you.
Yeah, we've made so much money off of you that of course you're good for it. We've seen all
VIP
this money
client.
flowing. Yeah, right. You
So
got it.
I think that that's a really important thing to touch on quickly, because I know we've mentioned it in previous episodes, but this is, the noise around infinite banking sometimes deviates from the core message that this is really, truly about creating our own banking system that we control and not giving up control to commercial banks. That's in a nutshell all it's about. And if
Mhm.
you're new or you haven't heard it in a while, I think it helps to understand why that's necessary if you understand how commercial banks work. And I think, and I wasn't aware of this really until a couple years ago, and it was kind of depressing to learn it, to be honest. But when you give a bank money in the form of a deposit, your money doesn't just sit there, until you decide that you want to take it out. I always knew that they put it to use in some sort of way, but I didn't realize to what extent. So, because of fractional reserve banking, they are allowed to keep a small fraction on hand of deposits and lend out an exponentially higher amount to make money. And at this point, John, correct me if I'm wrong, but I believe the last figure that I saw was it's something like 10 to 1. So if you give the bank $100, they can lend out 1,000, right? Which is pretty crazy. So essentially, they're lending out money all the time that isn't really backed by any sort of substantial deposit. Um, and
Well,
like John,
yeah,
sorry,
go
go
ahead.
ahead.
Continue,
No, no, no.
continue that thought. Oh, okay. So you
Yeah,
said, correct me if I'm wrong.
correct me if I'm wrong.
That what you described is what they mean by fractional reserves, right?
Right.
So they only have to have a fraction of of what was deposited, right? They only need a tenth of it, is what you're saying, and that
Yep.
is true. Except it's argued that, and because I haven't come down to the exact documentation, but I've seen it and heard it many times. In 2020, the banking regulators and other powers that be, said they don't even have to have any reserves.
So I had heard that too, and I didn't know if that was true, but well,
I'm
if that's
pretty
the
sure it's
case,
true.
it's even
Yeah.
scarier, right?
Well,
But
yeah. I mean,
what it's kind of a
when you
tenuous place to put your money if you think that, in order for them to go lend out $1 million, they only need to have at this point, I could be effectively nothing on hand or 10,000 or 50,000 or $100,000. That doesn't sound like a very strong system. And John and I were talking about this before. It's not like a somewhat more of a fair system where, let's say, I mean, I've had brokerage accounts reach out to me and they say, "Hey, we'd like to pay you some money to lend out your stocks to people that maybe want to take short positions." Okay, that's fair. Thanks for asking. Thank you for giving me the money to do that. I am never asked by the bank if they can lend out the money that I give them to deposit. I'm not told, "Hey, we're going to go take some risk and loan your money out to make 14% and we'd like to give you, 6% in return." Doesn't happen that way. It's just done in the background without our permission, in in at a level that's really reckless, right? I mean, it's kind of scary
well,
when you get into it.
yeah. I mean, we probably could go on for
Well,
at
well, we
least
could
an
go down a
hour on this
rabbit hole with
subject.
this one. Yes.
No, no, it's great stuff. I
Yeah.
think it's we're trying to really get. So the flip side, right, with a whole life insurance policy, in essence, you are telling them, like you just described, like we would love it if the bank says, "Hey, we're gonna go risk some of this capital that you've put in here, but we're gonna give you 5.5% of it, and we're gonna go try to make more than the 5.5%." In essence, that's what we're doing when we leverage this capital pool that we put into our banking system. And when we borrow against that, you know, we're borrowing from the insurance company and we're saying, okay, whatever your rate is, we're agreeable with that, because we're going to go off and do something that's valuable to us, whether it's an actual investment that most people are familiar with, right? Like buying a business,
Hmm.
getting into something where you think you're going to get a greater return than the wholesale rate you're getting from the insurance company. And that's where we talked about, what is infinite banking? Well, that's really what you're doing is Nelson didn't use this language, but it was basically wholesaling. And then reselling, like, hey, I buy a t-shirt for $10 and I sell it for 20. I bought it wholesale for 10. So I'm buying the rate, say at 5.5 from the insurance company, And the idea is whether I'm lending it to someone else or I'm lending it to myself, Nelson says, hey, why don't you respect your own capital and charge yourself 11%?
Right.
Charge somebody else 11%, right? So you actually are flipping it to make it a reality what you just mentioned you wish
Hmm.
they would do for us. But they're never going to do that
Of course not.
because that's
No.
too good a system for them, right? Why would they let it on, change it now? They've been allowed to do this by the consumer or by the consumer slash lender because we've been wholesaling our money to them. And they've been going off and making all this other money and they don't share much of it with us. So,
Right.
you know,
Yes. And it's kind of a scam when you look at it. I mean,
what do you
truly,
mean,
it
kind
really
of?
is
It's a
because they.
straight up scam.
Yeah, it is. I mean, it's really bad, and I've at times tried to bring this up to different like family members or friends, and they think I sound like a nut job. And if you know me in real life, I'm not really like a over the top conspiracy theory type of guy, but like this system makes absolutely no sense. It is broken. It's really pretty disgusting, and it's fit to serve nobody but the banks. And just like you said earlier, the worst part is that after someone that has, let's say, over a lifetime put in $1 million into banks, in and out with different deposits, different paychecks from different jobs, whatever. Well, they've made the bank tens of millions of dollars with that money over those years, right? And let's say that they have a big unexpected medical expense when they're a little bit older and they need to take a loan, and the bank decides that they'd rather not take that risk because whatever reason they come up with. Well, they have every right to do that. And the beautiful thing with this is that, and we've talked about this before, John, with the cogeneration banking system, you're essentially, by paying premium, you're helping to fund this business that you instantly become a part of, and you have contractual access with no questions asked. You're first in line to get capital when you need it. It's completely different. And the other awesome thing that I love about insurance companies is, by nature and by regulation, they can't overextend like that. They have to have certain reserves on hand to handle all of their expected payouts and everything like that. So by nature, they're, I mean, almost infinitely more conservative financially than a traditional bank.
Yeah, I mean, yeah, infinite would be a good word, but yeah, not but to add to that, is the fact that what we said in 2020, the regulators said, hey, you don't even have to have any reserves, right? So literally, there's no real money there. Of course, people can load them up with these pieces of paper, and if we want to go in and ask for some of it, but even one day, I went to the bank and I asked for 4,000 out of my savings, and um, we just for the accounting department, we need to know what are you using the money for? I'm like, they're
Hmm.
keeping records on what I'm using the money for. I said, whatever, it's really not your business, it's mine. And they got some young guy that he's being told to ask these questions, right? But the fact is, that, they don't have anything necessarily. They could. It's up to them if they want to have some reserves. They can have them, but they aren't required to have them anymore. And the insurance company that you and I do most of our business with, uh, they have 100%. In fact, they have 107% reserves against their liabilities. So they have
Hmm.
7% more than the full liability,
Yep.
right? So they're the total opposite end of the spectrum
Yep.
than a bank. And we're trying to show you that if you flow your money, we're not getting away from using the commercial banks. We use checks, we use debit cards, whatever. Um, but we're talking about pay yourself first, flow it into your banking system first through this whole life insurance, which is in essence the concept behind this, right? Is to flow it into your system first, then go and do everything else. And when you're borrowing it, you pay it back like you'd pay back any other borrower, and hopefully at a higher rate, or that type of thing, or just keep piling the money in after you've finished off paying, and creating several branches of your banking system. And, then you, over time, throughout your own lifetime, and as you teach your family, this goes on, and that pile just gets bigger and bigger. And that's why Nelson said, my grandchildren will never see the inside of a bank, meaning they'll never need to utilize a commercial bank because we've got all our needs. We've capitalized enough, and we'll continue to do this. And that's what many people are doing through practitioners like you and I,
Mm-hmm.
is they're building this system. And if we do that, well, then you get away from this place where if you are in need, that somebody's going to say potentially no. Uh, and and when you have no reserves in the banking system, let's say very few reserves in the banking system right now, and that's across the United States, it's pretty much the story across the globe. Um, when things do go downward, and we have a collapse, we have a bust of the system and a restart, that is the time when, geez, I've lived through it multiple times, Doug, where they say banks just aren't lending. They're not lending. It doesn't matter whether people have a viable business, have cash flow, have jobs. If they're not lending, they're not lending. You can't force them to do it. But you know what? If you had your own capital pool, you don't even have to try to force your insurance company to lend to you. They are required to.
Yep. It's a
They are
if anybody's never taken a
required.
policy loan, it's a very different process.
It's a
Very
totally different animal. It's
totally different.
in flipped it. It's
Yep.
flipped the script to your side, and leaves you in a much more secure place.
Well, it essentially puts, I mean, picture now instead of going and kind of putting your hands out to the bank and saying, I'd like a loan and fill out all this paperwork and see if I qualified, you essentially have the same function as the banking executive that gets to, stamp off on which loans are approved, pass underwriting, all this kind of stuff. And you get to just give yourself a loan whenever you want because you've put the money in. And it's as simple as that. You've paid into the system and you get to access the money whenever you want. I mean, I pose this question because it's really simple. After listening to John and I talk about the attributes of banking with a whole life policy and then the attributes of banking at a normal bank, which one would you rather have your money at? I know the answer for me, and I can tell you that, you know, I, I, I can tell you that if my bank were to collapse, I'd be fine. I have very little money in my bank account at any given time, right? It's more like John talked about, it's out of necessity. I use it to pay credit card bills, which I use to buy food and gas and all that kind of stuff. But um, people, I think, have already forgotten what happened with the banks last year. Those banks and a lot more should have collapsed. They were propped up by the Federal Reserve when they should not have been. And so the situation really should have unfolded to be a lot worse than it really was. And there's a lot of banks are still on very tenuous footing. And I don't think that people realize that. And in the event that something happens, I'd rather be in a position of protecting what I've worked for over the years. And I know that if there's any sort of financial institution out there that can weather the storm, a whole life insurance company is going to be the one to do it, a mutual whole life insurance company. And I would, if anybody wants to read more about this and learn, I would urge anybody to read How Privatized Banking Really Works. It was written by Carlos Lara and Robert Murphy. It's a good book. I will say that for me, it was a little bit depressing reading that for the first time, but it's certainly illuminating if you really want to understand how the banking system works and just how uh, tenuous it is.
Yep. Yep. So, if the audience and you, Doug, can bear with me, I want to quote some things from some court cases. When they created this fractionalized banking system, the bankers still had to convince Congress, the government, um, that basically the money on deposit was a good faith debt. It was actually a good faith debt of the banks, right? So the bank, technically, this becomes what they call a liability, right? It shows up on their books as a liability. And they also can flip both sides. They can have an asset and a liability. But it's is as I say, they said it was a good faith debt, that the money deposited was a debt owed to the depositor, but not something stored for safekeeping, um, and therefore could be loaned at risk. And there was lawyers who were able to convince the you know judiciary, um, to basically rule in favor of this, basically fraud. Um, because that's not what the color, it's like the color of law. They've made people believe one thing. People believe that that's theirs, but really it just becomes a debt that the banks say they will pay you back, right? And what do they even pay you back with? They pay you, and now they just pay you back with another piece of debt. They don't, this isn't real money. But that's a whole nother subject. I just want to quote a couple things. Um, in 1811, there was a case called Carr versus Carr, Carr with two R's. Um, and there was a British judge, Sir William Grant, who ruled that money paid into the bank was a loan transaction rather than a bailment, which means you're putting it in, you're bailing it into the bank. So it was a loan
Hmm.
transaction. 5 years later, Devanes and versus Noble, uh, it's quoted as saying the very same dishonest judge insisted that money paid into a bank immediately becomes part of the general assets, and he is merely a depositor for the amount. And then shortly thereafter, in 1848, this is very telling, I think. A judge, Lord Cheltenham, repeated the same fraudulent reasoning, and the money placed in the custody of a banker is, to all intents and purposes, the money of the banker to do with as he pleases. He is guilty of no breach of trust in employing it. He is not answerable to the principal if he puts it into jeopardy. He engages in hazardous speculation. He is not bound to keep it or deal with it as the property of his principal, but he is, of course, answerable for the amount because he is contracted. Well, it says he's answerable, but we've seen these banks get bailed out over and over, including last year in March of, you know, all the banks didn't, the depositors did. I mean, it's all funny money anyways. But the fact is, we can do things with these pieces of monopoly money because everybody believes it's worth something. But you want to put it through your banking system, not theirs, because you've lost total ownership of that money. You may get it back out, and we often do, right? But there is a time when you might need it, and they're not going to lend it to you, no matter how much you've given them. There's no goodwill that you've built by banking with some bank for years. They call them your
Hmm.
friendly banker. Well, they're friendly because, man, they love it when you give them your money, right? Now they can do
Yes.
whatever the heck they want to do with it. And then somehow we're supposed to bail them out when, whether it is direct, it doesn't feel like, oh, did that come out of my paycheck directly? No, but it's called inflation, right? They create a whole bunch of new money to bail out these banks.
Hmm.
I heard something, Doug, on an interview yesterday that, there was this thing called TARP during 2008, which I can almost see the headlines in the newspaper when there's still newspapers, even just that short time ago, you saw them all the time. But, $700 billion was going to be this TARP plan. I forget what it stands for, something asset recovery program. And maybe they asked, whatever.
Targeted. I bet it's targeted.
Okay. So yeah, whatever.
I'm making
Everybody
that
can look
up.
it
That
up.
sounds good. Targeted asset recovery program. Okay.
Yeah,
I'll look it
yeah.
up. Here, keep going.
It was 700 billion. Well, this woman who's done investigative journalism, which is so rare these days, and
Troubled
written a book,
asset relief program. That's
troubled.
what
Yeah,
troubled.
troubled.
Okay.
That she said that actually is close. So we were astonished, and they were trying to sell us on this idea of, hey, we're going to bail out these troubled assets, which are all these bad stuff that they created on Wall Street and through the banking system, and they were going to pay 700 billion. She said that it was more like 23 trillion dollars.
Oh yeah, with all the
So,
mortgage-backed securities and stuff like that. Yeah, it was scary.
which didn't even some of these pools of pooled securities, pooled mortgages. She even said that there was so-called securitized pools that didn't actually have the mortgages in there.
Mm.
So there, some of the people that got foreclosed on did end up getting their houses back because they weren't even in there once they they dug into it. But as long as you're oblivious to what's going on, there's pirates, there's thieves out there. I mean, I think that's what Andrew Jackson said. He said, "You're a den of thieves, and I'm going to rout you out."
Yeah.
Something along the lines of, by God, I'm going to rout you out. And he did succeed at that time. But it's been a battle. Some good, leaders, many many years ago, because that was in the 1800s. But now they're all on the same team. So I did get a little political today, but the fact is, it's not a safekeeping. You are loaning your money to these investors. So
Yeah.
let's put the money in your system first and always have it available to you and forevermore, and keep piling in, just keep bailing into yourself and for your family, and then you can help beyond your family, right? The bigger it gets. I'm not talking about just, only taking, caring for yourself. If you want, you can care for others if you have it, but you can't care for anybody. You can't really do charity when you don't have any money, right? Even though you
Mm.
might be charitable in your actions, you certainly can't do anything by, financial means, right? And that's my getting up on my stump today.
On your stump.
Yeah.
Well, what's that quote from the book that Nelson says? If you know what's going on, you'll know what to do. Something to the
Yeah,
effect of
yeah,
that,
exactly. Right,
right?
right,
So that's
exactly. So if you really know more of this outside stuff, then you start saying, okay, that's why Nelson came up with this. It wasn't that, even though he was a life insurance agent, it wasn't about just selling life insurance. He
no.
realized it saved his butt. He didn't have
I
to go
mean,
bankrupt.
I'll be honest. Like for it'd be a lot easier if I was out there just slinging term insurance and annuities. Honestly, I mean, I would,
Of course.
people have heard of it. You can just, the market for what John and I do is substantially smaller, but we do what we do because we believe in it and we do it ourselves. Um, and so, and Nelson could have certainly probably done much better, not solely focusing on this as well.
Well,
Financially, if he had wanted to, right? I mean, but he chose to really devote his life to spreading this message.
well, I want to just, in case anybody thinks that this isn't a way to really make money, because I think in the end it did work out better for him financially because he did become his own banker
Mm-hmm.
and he did leverage his assets in policies to do other things, to invest in other things that over and above, whatever his
Sure, that's a
borrowing
good point.
wholesale
Yep.
costs were. So yeah, I just want to be
Yep.
clear that, and maybe it doesn't look like that from the outset to somebody, but like you said, if you understand what's going on, you'll know what to do, because the other direction is well, I'm borrowing this from somebody else I listened to recently. It's a game of extraction. The system is really extracting from most, as opposed to providing and creating more abundance for everyone. There's a small group, um, that's, we could say it's because they understand money well, yeah, but they also understand the racket of it all, right?
Hmm.
And their families have been at it. Believe me, this isn't just like come out of nowhere. Their families have been at it for hundreds of years, um, and redefining it and uh, or just refining it, right? And yeah, so they've been really extracting from people as opposed to creating abundance for all people, right?
Of
Because
course.
they don't want to let on that this is their game. We're trying to shine a light on it, and like I said, if you pick up, if you're listening and you own becoming your own banker, just look at the section in the back of Nelson's book, that's just recommended reading for those interested in the stock market. And I think I've mentioned this in previous episodes, but there's a section on page 85. Um, Wealth has to reside somewhere. Where would you prefer to have it reside? The first three bullets: real estate, the stock market, or a free contract with other free persons, which he's really talking about life insurance. But when he talks about the stock market, he says, then try reading from my recommended reading for those interested in the stock market on page 91. Until you have done so, are you qualified to make an intelligent decision about such action? And those books are all like 20 to 25 years old, most of them. And there's been 20 to 25 years, and trust me, I own a bunch of them, and there's nothing uh, authentic about that world. They're not, I mean, they're a game of extraction, and it's a lot of it's corrupt, and it still goes on today. And you might say, yeah, but I'm making money, blah blah blah. Well, uh, he's saying, I'm saying, do whatever you want, right? But maybe you could do better if you started with your own banking system with a whole life policy. And in fact, you should do better,
Mm-hmm.
because you're going to be in control.
Amen.
Amen. God, in the name of the Father. Yep, for sure. All
I don't
right.
have anything to add to that. Well, no, you well said. Yeah, great. I love it.
Yeah, thanks, Doug. Appreciate that. Well, thanks everyone. Please like, share, all that stuff. Subscribe, follow, and please send us questions. Make comments. They don't have to be questions. If you don't agree with us, you don't agree
Tell
with
us
me.
why.
Yeah, and yeah, let's, because maybe we're missing something, but if we don't hear from you, we don't have the opportunity to learn and grow too, at least from you.
Exactly.
So
Yep.
thank you.
Well, until
All right.
next time. Thanks, John.
That's a wrap, Doug.
That's a wrap.
All right, buddy. Talk to you next week.
Bye.
Yeah, bye.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.